there, happy Friday. Well, today we are going to dig into the topic of Fannie and Freddie. What the heck is Fannie and Freddie? My clients ask me that all the time. So today we are going to dig into that topic with Susan Moeller, who is a leading industry specialist, and she's going to kind of tell us the difference and dispel some of the myths. My name is Pam Wacholtz. I am a local realtor. I am full-time and have been doing this for about 12 years, and I love working with my buyers. And I want to make sure that you are informed, which is why we are doing this Friday series. So please welcome Susan Moeller.
I am Susan Moeller. I live in the Austin area. This is going on my 15th year in the mortgage industry. I work for Lend Mortgage, local Texas company, and hopefully I can answer some of those questions for you today. I'll just kind of dive right into it, Pam. The Fannie Mae and Freddie Mac. I think everyone, regardless of whether you are currently trying to purchase or thinking about purchasing or hearing the news about mortgage-backed securities, as they would call them, Fannie Mae and Freddie Mac come into those conversations quite often in the mortgage industry. The big differences between Fannie Mae and Freddie Mac is that two are basically government entities that sort of regulate the mortgage industry and guidelines, if you will. You can be getting a conventional loan, an FHA loan. It is going to either close under the Fannie Mae or Freddie Mac guidelines. No matter what that loan program is. And that's just because there are two different underwriting systems that are used when we run these through our automated systems. We're really looking for what's called an automated approval when we run it through those systems. One is called Desktop Underwriter, which I'm sure you've heard of many times. The other one is called Loan Prospector. Desktop Underwriter is what's used for Fannie Mae type loans, and Loan Prospector is what's used for Freddie Mac loans. Okay. So that's a very technical sort of explanation of what's happening on the backside. And the reason why that's important is that at times you may be applying for your loan, and I'm just going to use conventional as an example, but this applies to conventional FHA, USDA, as well as VA. So we're still running them through those two systems. So let's start with just a conventional loan for an example. And so we'll run it through those systems. Sometimes you might try to run it through one system and you get an approval or a not approved. And then you run it through the secondary system, and then lo and behold, it does come back approved. And so that's why those two different systems are sort of important, and the guidelines come into play because each government entity has slight little differences in what they may or may not require. I'll give you an example right now. I've got one that I ran yesterday, and it was approved by Fannie Mae Desktop Underwriter, but not Loan Prospector. Exact same loan, literally ran it through at the same time. I could probably dig in and try to figure out why the one was approved versus not approved, but that can definitely happen. The other thing that may come as a result from the approval conditions for that approval, one might require 1 month of reserve, one might require 2 months of reserves, one might require no months of reserves. And so yes.
When you say reserves,
yes. So reserves, so that's obviously a term that you're going to hear as well. So reserves is the extra cash you have in the bank. After down payment, after the closing costs that are your responsibility at closing. Reserves mean basically the money that you're going to use to cover your mortgage payment if you don't have the payment that month.
We don't want people to be house poor.
No, absolutely not. Definitely not. Definitely don't ever want to be house poor when you're entering into your purchase. That's not any place that anyone wants to be at all. And so that's one of the reasons why that's kind of built into those systems to really just protect the buyer at the end of the day. And so really, like I said, they have pretty minor differences. Most of the time it might be reserves. Sometimes Freddie Mac can be a little bit more flexible in terms of the guidelines. So if it's, again, not approved through Fannie Mae, then I'll run it through Freddie Mac to see if I can get approval, obviously. But even like investment type property purchases, Freddie Mac is actually a little bit more forgiving on investment type purchases as well. So just minor little differences between the two. And yeah, that's it.
So where do your overlays come in?
Overlays. So these are, you're going to hear this too. So one of the questions that I know that you said that you get from clients sometimes, and they may be working with two different lenders, and one said that they need this, and one said that they need this, or one said they couldn't do the loan, and the other said that they could, and it's the exact same loan, like I said. So there are what are called lender overlays, in addition to those Fannie Mae and Freddie Mac guidelines, as well as conventional guidelines, FHA guidelines, VA FHA guidelines. Each loan program has their unique set of guidelines and what may or may not be required. Good example, just very quickly, would be for someone with a VA loan, for example. If they don't have a 2-year work history, it's almost a hard stop, depending on the circumstances. Like if they were in school and then got their job. But if it's just somebody that just entered into the workforce and they decided to go back to work and they've only been working for a year, it's a hard stop, and so with like conventional FHA, there's more flexibility in that regard. So again, those are loan program guidelines. Going back to overlays though, I'm going to give you a really good example that I had just yesterday, actually. It's a VA refinance, actually, and the approval came out on it with a VA interest rate reduction loan, which is a little bit different. So basically, any of these loan programs, you can have your be paying on your house for a period of time, and they'd be eligible for what's called either an interest rate reduction loan or a streamlined refinance, which I'm sure you've heard of. It's very little underwriting guidelines that are involved. They're not looking at debt to income ratios, which I'm sure we might get to in a second. They're not looking at the longevity on your job. They don't care that you went out and bought 3 boats since you closed on your home, things like that. They only are looking at whether or not you paid your mortgage payment on time. On this one specifically, the typical loan program says that an appraisal is not required, but when I got the approval from this particular wholesale lender partner that we work with, they're asking for what's either called an AVM, which is an appraisal valuation model, which you may be familiar with, or what's called a 1055, which is basically an exterior appraisal only. And so I reached out to that underwriter yesterday. I said, hey, just kind of making sure, because I wanted to see if it wasn't something that was just missed, I said, is this a lender overlay? And so sure enough, he did respond this morning. He did say it was a lender overlay. And so we're going to have to get that additional requirement, even though if that loan would have been placed with one of our wholesale lender partners, it would not have been required. Yeah. So some other big differences that might be there is sometimes, I kind of talked about the automated response. So that is basically an automatic approval almost, because you're getting that automated response that it gives you almost, you've got a home for that loan somewhere, if you will. Now, what you can also get is what's called refer to underwriter response, which I'm sure you may have heard of. So this is what's called a manual underwrite. So it's not being underwritten through this automated system. It actually needs to have that loan file presented to the underwriter to determine if it meets those guidelines. Underwriter's always going to review the file even with the automated underwrite situation. But in that case, different lenders may have different requirements as well. So some lenders may say, okay, we'll take that without that automated approval. We'll do the manual underwrite. We are going to need, though, 3 months of reserve, 6 months reserves, depending, credit score requirements, things like that.
So it's almost like when you have someone that's looking for rental and they've got some things that don't fit the mold, and you go to the owner and say, look, they're willing to pay, the last 2 months rent up front. They're willing to do this. Will you work with us? So it's almost like that.
Or, have those reserves.
Right.
Or, maybe they have a retirement account. They don't have to withdraw those funds, but the fact that they have the retirement account, that can count as reserves. And so those things will make a difference on whether or not that underwriter will approve your loan or not. Yeah, for sure. Yeah. And so, that's a big part of it. What other questions do you see from your clients?
I know the whole DTI thing is, people are like, what the heck is that?
Yeah. So this is, for me, like when I'm composing an email to a client for an example, I'll mention DTI, and some people know exactly what that is. And then others, and a lot of times I'll even put in parentheses what it is, get exactly what that is, because the DTI is debt to income ratio. Okay, so this is a simple equation. Okay, you're taking your total debts, you're taking your total income, and you're basically dividing the debts by the income to get a percentage, which is the ratio.
Okay.
And so each loan program will have its own requirements or guidelines for that as well. Conventional, for the most part, you want to kind of shoot for like a 45% kind of DTI threshold. Running it through those systems, that can vary wildly depending on credit score, how much your down payment is, things like that. FHA though, which is a lot more lenient program, you can go as high as 57% on that DTI. So, again, trying to envision what that is. That's your total other debt load, your income, your projected house payment, taxes, and insurance are also part of that equation, as well as any homeowners association fees, unfortunately.
My favorite thing.
Which you gotta always watch out for. Flood insurance even, all of those things are going to come into play with that. And so you can get approved for that FHA loan a little bit more easily in that regard if the DTI is higher. VA has the most flexible DTI thresholds, believe it or not. I won't get into all that. That might be a different conversation for another day topic. But USDA is the most strict. So they're hard set depending on what your credit score is. It might just be 39%. It's got a lot of different brackets there.
Well, that makes sense because that's a zero down loan.
Yeah,
so,
for sure.
Yeah.
And they're really, targeting trying to help a specific individual, which could be a more moderate income or some of these underserved areas.
Yeah. Okay.
Yeah. So.
All right. Well, wow. You've given us a lot of great information.
Thank
Is there
you.
something else?
The thing I would just say, since this is more of a base education piece, is that, as you prepare to enter into that market of purchasing your home, whether it's your first home or your third home, the things you need to be watching out for are obviously your finances, keep those debts low, you want to save as much money as you can. Know that there are options if you don't have the 20% down. First-time homebuyers unconventional can go as low as 3%, FHA 3.5%, or even the USDA 0%. So those are all different options at your fingertips. And so just be mindful of your spending habits. Yeah.
Well, and I've got a whole list when I do my buyer's consultation of, okay, raise your right hand.
Right.
We're going to agree. You're not going to co-sign for somebody. You're not going to decide to be unemployed. You're not going to go out and buy that Ferrari.
Don't take a loan for your closing costs.
Don't go to Lowe's the week of closing and buy appliances on credit.
Do it the next week.
Yeah.
not that I'm telling you to.
So, okay, this is great.
Good.
Thank you so much.
Of course.
I think this information will definitely help. Because there's so many questions out there. There's so many people that have just been sitting on the fence about buying a house.
Yeah, for sure.
And, knowledge is power.
It
really is.
Yeah.
So when you think you're ready, even when you're at the preliminary stages of, I think I'm ready to buy a house, but I haven't really started getting things in order, it is always good to go ahead and talk to an experienced realtor and an experienced lender and just see what is the big picture. Come up with a game plan. Even if that game plan means you're not closing on a house for another 18 months or 2 years, come up with that game plan so that you're not doing things along the line that can mess things up when you really, when you're at that point of, pulling the trigger.
Exactly.
So,
yeah.
And just want to thank you for tuning in, and thanks, Susan, for your time and for the information.
Of course. And just reach out to us when you're ready. We're always here to help.